You open a crypto exchange for the first time. The screen is overwhelming. Green candles, red candles, numbers moving faster than you can read them, a chart that looks like a heart monitor for something that is either very alive or about to die. You have $500 you decided you could afford to lose. You don't actually want to lose it. You close the app. You open it again, you close it again. This is where every trader begins. Not with confidence, with the specific paralysis of too much information and no framework to organize it. This video is the framework. Level 1. What you are actually looking at. The chart on your screen is not chaos. It is a record of every decision every buyer and every seller made about the price of an asset over a specific period of time. Every single candle on that chart represents a battle between people who thought the price was going up and people who thought it was going down. The candle shows you who won. A green candle means buyers won that period. The price closed higher than it opened. A red candle means sellers won. The price closed lower than it opened. The wick, the thin line above and below the body of the candle, shows you how far the price traveled before it came back. A long upper wick on a green candle means buyers pushed the price high and then sellers pushed it back down before the period closed. That is information. That is not noise. You are not reading a chart. You are reading a record of human decisions made under uncertainty. Once you understand that, the chart stops being overwhelming. It becomes a story. Level 2. Trading pairs. What you are actually buying. You don't buy Bitcoin. You buy BTC/USDT. You buy BTC/ETH. You buy a relationship between two assets. The trading pair tells you what you are exchanging and what you are exchanging it for. BTC/USDT means you are trading Bitcoin against Tether, a stablecoin pegged to the US dollar. When this pair goes up, Bitcoin is becoming more valuable relative to the dollar. When it goes down, Bitcoin is becoming less valuable relative to the dollar. This is the pair most beginners start with because it behaves like what you are used to, a price in dollars. BTC/ETH is different. When this pair goes up, Bitcoin is outperforming Ethereum. When it goes down, Ethereum is outperforming Bitcoin. You are not measuring against dollars. You are measuring one asset against another. This is a more sophisticated trade and carries a different kind of risk. Know what you are measuring before you measure it. The pair is not a detail. The pair is the entire trade. Level 3. Support and resistance. Where the battles happen. Every chart has levels where price tends to stop, where it bounces, where it reverses. These are not random. They are the memory of the market. Support is a price level where buyers have historically shown up, where the price has fallen to a certain point and then recovered, multiple times. The more times it is held, the more significant the level. When the price approaches support, buyers remember what happened last time. Many of them buy. The price holds, until it doesn't. Resistance is the opposite, a price level where sellers have historically shown up, where the price has risen to a certain point and then fallen back, multiple times. When the price approaches resistance, sellers remember. Many of them sell. The price falls, until it doesn't. When support breaks, it often becomes resistance. When resistance breaks, it often becomes support. The market has a long memory and a short attention span. Your job is to find the levels where enough people remember the same thing at the same time. This is not a guarantee. It is a probability. Trading is always probability. Anyone who tells you otherwise is selling something. Level 4. Fees. The cost of being in the game. You are going to pay to trade. Every trade, every time. This is non-negotiable and almost nobody talks about it clearly at the beginning. There are two types of fees you need to understand: maker fees and taker fees. When you place a limit order, a trade that waits at a specific price, you are a maker. You are adding liquidity to the market. Exchanges reward this with lower fees. When you place a market order, a trade that executes immediately at the current price, you are a taker. You are removing liquidity. Exchanges charge more for this. On most major exchanges, maker fees run between 0.1% and 0.25% per trade. Taker fees run slightly higher. This sounds small. On a $500 trade, it is 50 cents to $1.25. On a $50,000 trade, it is $50 to $125. If you are trading frequently, fees are not a footnote. They are a significant factor in whether a strategy is profitable after costs. Calculate your fees before you calculate your profits. A trade that looks like a 2% gain before fees can be a 1.5% gain after them. Compounded across dozens of trades, the difference is not small.
Level 5. The first trade. You have a chart you can read. You understand the pair. You have identified a support level the price has respected 3 times in the past 30 days. You have calculated your fees. You have decided in advance how much you are willing to lose on this trade if you are wrong. You have written it down. You place a limit order just above the support level. Not a market order. You are a maker, not a taker. You set a stop loss below the support level. If support breaks, you exit. You do not wait to see what happens. The plan was written before the trade was placed. The trade executes the plan. You do not execute emotions. You wait. The price comes to your level. The order fills. You are in the trade. Your heart rate changes. You check the chart more than the plan says to. You already know this about yourself. You close the app. You open it 4 hours later. The price has moved in your direction. Not dramatically, not life-changing, but in the direction of the thesis you built before the emotion had a chance to interfere. You close the trade at your target. Your first profitable trade is a small green number on a screen. It is not the money that matters. It is the process that produced it. That process is now yours. The question is not whether you understand it. You do. The question is whether you are ready to trust it when the chart is moving fast and the candles are red and every instinct you have is telling you to do something the plan does not say to do. That question does not have an answer yet.